Welcome back to the deep dive. So today we're going to commit a little bit of what I'd call financial blasphemy.
A little bit. I think we're going all in.
Okay, a lot.
Yeah.
We are taking a sledgehammer to, one of the holiest pillars of the American dream.
It's that classic script, right? Work hard, buy a house, pay it off as fast as you can.
Eat rice and beans for a decade to do it. The goal is always that mortgage burning party. Total freedom from debt.
It's the ultimate badge of honor. I mean, it's what our parents did, it's what their parents preached, and honestly, it just feels so intuitively safe.
It does. It feels responsible. But we have a stack of research here today. Sources that frame this almost like a forensic audit on home ownership that suggests this might be, well, the worst financial advice you can follow right now.
They're calling it the home equity trap.
Exactly. And the main takeaway seems to be that by rushing to pay off your home, you aren't building wealth. You're actually imprisoning your money.
It's a bold claim, and I know it makes people really uncomfortable. But think of this deep dive as, let's say, an intelligence briefing.
Okay. I'm going to step into the role of a real estate strategist here. And our mission is just to strip away all the emotion from the word home, the memories, the comfort, and just look at the cold, hard math.
Because when you do that,
you realize that a paid-off house often leads to being house rich and cash poor. And in a high inflation world, that is a really dangerous place to be.
House rich, cash poor. I've heard that phrase, but the sources we looked at use a much more visceral image to describe it.
The drywall prison.
Yes, that one. It's the perfect visual for what we're talking about.
It really is.
So walk us through this. Because when I look at a wall in my living room, I see paint. I don't see a prism.
Right. So imagine we take a cross-section of that wall. You've got your 2x4s, wiring, all that. But in this scenario, instead of that pink fiberglass insulation, you've stuffed all the space between the studs with stacks of $100 bills.
Okay, so just crammed with cash.
Trammed tight. That represents your equity. That's all the money you've poured into the principal over the years.
Right.
You might have $500,000 sitting inside that wall. Your net worth looks fantastic on paper. But here's the problem.
What's that?
It's rotting. You, the homeowner, are standing right there in the living room, and you can't touch it. You can't use it for groceries. You can't invest it. You can't use it for an emergency. It's physically locked away from you.
By the drywall. And the only way to get it is to basically take a sledgehammer to the wall or sell the house.
Or you have to go ask a bank for permission to hand you a shovel. And that is the essence of what the economists in our sources call dead capital.
Dead capital. That's the core idea we need to unpack.
It is. The argument is that equity in your main home is dead money. It's not working for you. It's just sitting there.
That phrase, dead capital, sounds so ominous. I mean, isn't saving money a good thing? How can saving money in my house be dead?
This is where the buried money analogy from the briefing docs is so useful. It sounds completely insane, but just stick with me because the math is, well, it's undeniable.
Okay, I'm listening.
Imagine you have $500,000 in cash, liquid. You put it in a suitcase, go into your backyard, dig a giant hole, and you bury it.
My neighbors would definitely call the police, but okay, I'm following. I've buried $500,000.
Now, let's analyze what happens to that money. First, it earns zero interest. It's not in a savings account, not in bonds, nothing. It has a yield of 0%.
Makes sense.
Second, inflation is just eating it alive. If inflation is 3-4%, the purchasing power of that cash drops every single year.
Right. The $100 bill is still a $100 bill, but it buys less stuff next year.
Exactly. And third, and this is the part that connects directly to housing, if you suddenly need that money, you can't just go dig it up. In this analogy, the bank owns the shovel. You have to apply, you have to pay fees, you have to qualify just to get access to your own cash.
When you lay it out like that, it sounds like absolute insanity. No one would do that.
But mathematically, it is identical to paying off a low-interest mortgage early. You're taking liquid cash money that could be earning 5% in a money market or 8-10% in stocks, and you use it to pay down a 3 or 4% mortgage.
You're burying it in the walls.
You are turning liquid capital, which is alive and powerful, into dead capital, frozen.
That's a huge mental shift because we treat a paid-off house like a trophy. We frame the deed. But you're saying it's not an engine for wealth.
It's a storage unit, and it's a storage unit that charges you to get your own stuff out. Remember, the equity itself has a 0% rate of return. If your house appreciates, it appreciates whether you have a mortgage or not. The cash you trapped in there contributes nothing to that growth.
Okay, this brings us to the forensic math part of the briefing. The sources break this down with return on equity, or ROE. And I want to dig in here because people usually just talk about home prices going up, not the efficiency of the money.
This is where the math really separates from the emotion. Let's run 2 quick scenarios. Scenario A, you use leverage.
The normal way.
The normal way. You buy a $500,000 house, but you only put $100,000 down. You've got a $400,000 mortgage.
Okay, $100K of my own skin in the game.
Right. Now, let's say the house appreciates by 5%. A pretty average year. That's a $25,000 increase in value.
Okay.
Now, what's your return on equity? You invested $100,000 of your cash, and you made $25,000. That's a 25% return on your money.
That's huge. That beats the stock market most years.
That's the power of leverage. Now, scenario B, the debt-free dream. You take an extra $400,000 you have and pay the house off completely. You are 100% equity, $500,000 buried in the house.
I'm sleeping great at night. No mortgage. The bank can't touch me. But what's the math?
The market doesn't care how well you sleep. The house still appreciates by the same 5%, still a $25,000 gain. But now, what's your investment?
It's the whole $500,000.
So $25,000 divided by $500,000 is
5%.
Exactly. Your return on equity crashed from 25% to 5%. By paying off that debt, you absolutely killed your returns.
So just to be clear, the house did the same thing in both scenarios, but in the second one, I used 5 times more of my own money to get the same dollar result.
Terribly inefficient. And the kicker is that $400,000 you used to pay off the house, it's gone. It's not earning interest, not compounding. You've essentially fired your best employee, your capital, and told it to go do nothing.
Okay, let me play devil's advocate here because I know what everyone is thinking. They're thinking, fine, the math is better with a mortgage. But what about the risk? Debt is risky.
That's the intuition speaking, yes. But the briefing brings up this fascinating counterpoint, especially for today's world. They call it shorting the dollar.
Shorting the dollar. That sounds like some Wall Street hedge fund move.
It is. But a regular 30-year fixed mortgage is the only way an ordinary person can really do it.
How does that work?
It all hinges on inflation. Think about it. With a 30-year fixed mortgage, you lock in a payment today. Let's call it $2,000 a month.
Okay, $2,000. Locked in.
In 2026, $2,000 is a pretty significant amount of money. It buys a lot of groceries, right?
Sure.
But what about in 2046, 20 years from now? With inflation, that same $2,000 might only buy you a loaf of bread.
Hyperbole, but I get the point. Its purchasing power is way less.
Way less. But here's a magic trick. Your mortgage payment. It stays the same. You're still only paying the bank $2,000.
So I'm paying them back with money that's worth a lot less than the money they originally gave me.
You are paying them back with cheap future dollars. You borrowed expensive today dollars. You are legally shortchanging the bank.
The source material had that great image, the inflation monster.
Yes. Like a giant moth eating a pile of cash. If your cash is in a vault, the moth eats your savings. But if you have debt, the moth is actually eating the burden of your debt for you.
So the mortgage is actually like a shield against inflation.
In a high inflation world, a long-term fixed rate debt is an asset. And when you rush to pay it off, you're voluntarily giving up that subsidy. You're using your valuable today dollars to wipe out a debt that inflation would have made tiny for you anyway.
You're basically bailing out the bank.
You're taking the risk off their books. Precisely.
Okay, that is frustrating to realize. But I still have to push on safety. I can hear people yelling, but a paid-off house is safe. If I lose my job, no one can take my home. And if I really need cash, I'll just get an HELOC.
Ah, yes, the HELOC defense. I was waiting for that one.
Well, it's what everyone says to do.
I know. But this is where you run headfirst into what the sources call the liquidity trap. And honestly, this is the most dangerous misconception in all of real estate.
Okay, break it down. Why is the HELOC not the answer?
Because banks are fair weather friends. They will lend you an umbrella when the sun is shining, and they will demand it back the second it starts to rain. Think about 2008. The sources bring this up. What happened when the crisis hit? Banks panicked. They froze credit lines. Millions of people had their HELOCs slashed to zero overnight. The money was gone right when they needed it most.
So the strategy of I'll borrow it when I need it just falls apart.
It assumes the bank will be willing to lend when times are bad. Now think about your unemployment scenario. You lose your job. You have a paid-off $500,000 house. You walk into the bank and say, "I'd like a loan against my house, please."
And the first question they ask is,
"Can I see your proof of income?" And you say, "Well, I don't have any. I just lost my job."
loan denied.
Loan denied. It doesn't matter that you have $500,000 in equity. No cash flow means you're a default risk. So now you are sitting in a paid-off house, potentially starving, with zero access to your wealth. You are house rich, but completely broke. That's the liquidity trap.
That is a terrifying thought. You're broke inside a gold mine you can't access.
Now, contrast that with the smart money move. You kept the $400,000 mortgage, but you also kept your $400,000 in cash or in a brokerage account.
But my assets and liabilities are balanced.
You're effectively debt-free, but with a crucial difference. If you lose your job, what do?
I just log in my account, transfer some money to checking, pay the mortgage, buy groceries, no problem.
Exactly. You have control. You can ride out that storm for years if you have to. When you send that money to the bank has the money and you have a receipt. When you keep it, you have liquidity. So I ask you, who is actually safer? The person with the receipt or the person with the cash?
The person with the cash. The safety of a paid-off house. It really does feel like an illusion when you put it that way. It's fragile.
That is the verdict. A paid-off house makes you feel safe, but liquidity keeps you safe. Dead capital is fragile. Liquid capital is anti-fragile. It's flexible.
So why is this paid-off advice so pervasive? Is it just stubbornness? Are we just wired to hate debt?
It's psychology, and we have to give that its due. We've talked about Morgan House's work before, and he makes that great distinction between being reasonable and being rational.
Right. Rational is what the spreadsheet says. Reasonable is what lets you sleep at night.
Exactly. And for some people, the anxiety of debt is just so visceral that paying it off is the only way they can function. And if that's you, if a mortgage gives you actual stress, then okay, pay it off. Health is wealth. But, and it's a huge but, you have to understand the cost of that sleep. You need to put a price tag on that peace of mind.
Let's do that. What's the insurance premium for sleeping well?
It's simple math. If your mortgage rate is, let's say, 6%, and the market historically returns around 10%, you are losing that 4% spread every single year.
On a big number, that adds up.
On a $500,000 portfolio, compounded over 20 years, that's not just a little bit of money. You are potentially losing out on millions of dollars of wealth.
Millions. So you're paying a multi-million-dollar premium for a feeling of safety that, as we just showed, might be false anyway.
That is the trade-off. Now, if you're 65, you're retired, you want zero risk, sure, pay off the house, you're in the preservation phase. But if you're 35 or 45 and you're in the accumulation phase,
Burying your capital is a crime against your future self.
it is. You're stunting your own growth for emotional comfort.
So let's bring this all together. Someone's listening right now, maybe they have a bonus coming, and they're holding the pen, ready to write that big check to the mortgage company. What is the final verdict from this briefing?
Stop. Put the pen down. The intelligence from these sources is clear. Don't rush the payoff. Let inflation do the work for you. Let the inflation moth eat the loan, not your savings. Your number one priority should be liquidity.
So cash is power.
Cash in the bank, or better yet, investments in the market is power. Equity in the wall is vanity.
Equity in the wall is vanity. That's the line. But I feel like there's a final trap here, isn't there? Because if I just keep the cash in a checking account, I'm back to the buried suitcase problem.
Yes, this is absolutely critical. This strategy only works if you are an active steward of that capital. If you don't pay off the house, but you leave that cash earning 0.01%, you are still losing. The inflation moth eats that too.
So you have to invest it.
You have to become an investor. You put that capital to work in assets that compound stocks, businesses, other real estate, whatever it is.
Right. The choice isn't pay off house versus buy a boat. It's pay off house versus build an investment portfolio that will grow much larger.
That's a fair point. For the disciplined investor, the future belongs to the owners, not just the debt-free. You want to own assets that grow, not just eliminate liabilities that are shrinking on their own anyway.
It really redefines wealth. It's not about what you don't owe. It's about what you control and what you can access when the storm hits. It's about not letting your capital die in the drywall.
Exactly. You can't spend drywall. Keep your options open. Stay liquid.
Amen to that. That's it for this deep dive into the home equity trap. We want to hear from you. Does this math change your strategy, or is that peace of mind worth the millions? Until next time, keep your capital alive.